Today's market moves weren't just about modest gains in equities. They reflected a subtle shift in how investors are balancing growth optimism against rising uncertainty underneath. The headline numbers looked relatively calm. The S&P 500 edged higher, the Nasdaq outperformed on the back of technology strength, while the Dow lagged, pulled down by cyclicals. Bond yields drifted lower, suggesting a bid for duration, and oil fell sharply. Gold was flat, volatility stayed contained, and the dollar didn't move much. On the surface, it looked like a stable day, but under the surface, the picture was more selective. What changed today wasn't the economic reality, it was how investors interpreted it. The drop in oil prices played a key role. Signals of potential de-escalation in the Middle East reduced immediate supply concerns. That eased one of the market's biggest short-term inflation risks. At the same time, U.S. manufacturing data showed continued expansion, but with rising input costs. So growth is holding up, but inflation pressure hasn't fully disappeared. And then there's policy. The Federal Reserve showed an unusual level of internal disagreement, with a split vote that highlights uncertainty around the path forward. That doesn't give markets clarity, it widens the range of possible outcomes. Globally, central banks are still leaning cautious, even slightly hawkish, which suggests liquidity may not ease as quickly as markets would prefer. So investors are dealing with a mixed signal. Growth is resilient, inflation is sticky, policy is uncertain. And that combination is shaping how capital is moving. Money today didn't move broadly into risk, it moved selectively. There was a clear concentration into technology, particularly AI-driven names, reinforced by strong earnings from major players. At the same time, capital flowed into crypto, suggesting pockets of speculative appetite remain. But outside of that, the tone was more cautious. Energy sold off despite recent strength, industrials and financials lagged, and defensive sectors weren't meaningfully bid either. This isn't a classic risk-on or risk-off environment. It's a narrow risk-on market. Investors are leaning into long-duration growth assets, supported by lower yields and lower oil, while quietly pulling back from areas tied to the real economy. That divergence is where things get interesting, because it introduces fragility. Market strength right now is heavily dependent on a small group of large technology companies. If that leadership holds, the index can continue to look strong. But if expectations around AI growth or earnings momentum begin to shift, the downside could be disproportionate. At the same time, policy uncertainty is increasing, not decreasing. A divided Fed means less clarity on rates, and that raises the risk of sudden repricing in bond markets. Energy is another layer. Today's drop in oil reflects easing fears, but the underlying geopolitical risk hasn't gone away. That creates the potential for sharp reversals. And then there's the consumer. On one end, high-end demand looks resilient. Strong results from premium tech point to that. On the other, weakness in lower income segments is starting to show up, suggesting the economy isn't moving evenly. So while markets appear stable, the foundation is more uneven than it looks. One question investors are debating right now is whether this narrow leadership is a sign of strength or a sign of vulnerability building beneath the surface. I'd be curious how you see it. Is this concentration sustainable, or does it increase risk from here? Stepping back, the broader signal from today is about expectations. Markets are leaning toward a soft landing plus continued AI-driven growth narrative. Lower yields support valuations, lower oil reduces immediate inflation pressure, strong tech earnings reinforce the growth story. But none of these are fully confirmed trends. They are assumptions being priced in. And importantly, the risks around them, inflation persistence, policy uncertainty, geopolitical instability, haven't disappeared. Looking ahead, several catalysts will test this narrative. The U.S. jobs report will be critical in shaping rate expectations. Ongoing earnings will test how durable this AI-driven growth really is, and any shift in geopolitical conditions could quickly move oil again. And central bank communication remains a key variable for market direction. What this suggests for investors is that the market's strength right now is real, but highly concentrated and dependent on a specific set of assumptions holding together. That doesn't make it fragile in the short term, but it does mean the margin for error is narrower than it appears. Markets rarely move on a single narrative, and right now, that narrative is being tested. If you find this kind of calm, structured breakdown helpful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here today.